Hi everyone, welcome to a brand new episode. I'm Marcus. Today we're looking at Visa, ticker symbol V. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. Should we be buying the stock right now? Let's find out. As I mentioned, we're looking at Visa, ticker symbol V, and they are traded on New York Stock Exchange and are in the trade and service sector. If you go down to the screen, we can see that their market capitalization coming in at $450 billion and the revenue at $25.5 billion and PE ratio at 45. Now, guys, I like companies with a PE ratio of 20 or below. So having 45, that is just way too high for me. So that is a no. But at the same time, guys, when you see a stock with a high PE ratio, that tells you that the market expectation of that stock is high, and therefore you might see capital gains on those stocks because there's a lot of investors that is pushing the price even higher because they are expecting better and better numbers. But the overhanging risk is, as we saw with Facebook, Netflix, and PayPal, is that if the company doesn't meet those expectations, we will see the stock price fall. Same thing when it goes when you see a stock with a low PE ratio, that tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks. Just keep that in mind. Profit margin coming in at 51%. That is just amazing. I like companies with a profit margin of 15% or higher. So coming in at 51%, that is a goal for me. Price to sales ratio coming in at 18. Normally, I like companies with a price to sales ratio of maximum 4. So coming in at 18, that is too high for me. So that is a no. Price to book value at 13. I like companies with a price to book value of maximum 3. So 13, that is too high for me. So that is a no. So if we were to summarize, PE ratio is too high, price to sales ratio is too high, and price to book value is too high. This tells me that Visa at its current state is overvalued. They pay out a dividend of $1.39. I like it because I like those recurrent income. Effective return at 0.7%. That is just way too low for me. So that is a no. I would like to see a range at least around 2.5, 3% or higher. But at the same time, guys, I want you to be very cautious here and not just jump the gun just because you see a stock with a high return, because that could be a trap. You want to make sure that you get good returns when you hold those stock, as long as you hold those stock. But at the same time, when it comes time for you to exit the stock, you want to make sure that you get a higher price than what you bought it for. So make sure to look at the chart, historical chart, and see, is this stock consolidating, or is it moving in a negative trend channel or in a positive trend channel, and will this trend turn when it comes time for me to sell? So keep that in mind. Don't jump the gun just because you see high returns. So return on equity, I have to report these numbers, but I would guess it's around 38%, and that is good. I like it. So return on equity tells you about a company's ability to create return on their equity, meaning that their ability to create return on the capital you want to invest in them. So make sure you have a company with a positive return on equity. So 38%, I like that. Return on asset coming in at 13%. I like it. So that is a plus. So the stock is currently traded at $217 per share. If we go down to the moving average, we can see that we are above the 50-day moving average, but below the 200-day moving average. This tells me that there is uncertainty here. The signal is not clear whether we'll see the stock price increase or whether it will decrease. But if we take a quick glance on the chart, we can see that we have been moving within a positive trend channel, but has lately broke below that channel and now has been consolidating. But we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement, and what we can see here is that the total revenue in 2017 came in at $18.4 billion and grew to $23.8 billion in 2021, and these numbers have been growing every year, fell off a bit in 2020, but overall trend is positive. Gross profit went from $15.8 billion up to $16.6 billion, and these numbers have been growing, fell off a bit in 2020, but overall trend is positive. Net income came in at $6.7 billion and grew to $12.3 billion, and these numbers have been improving. Once again, we fell off in 2020, but overall trend is positive. Now let's jump over to the balance sheet, and what we are interested here is that the current assets versus the current liabilities, and we can see that there is a huge difference between the current assets and the current liabilities, which is a plus. Basically, what it's telling you is that the current assets, if they were the company were to convert it to cash, they are able to pay off the current liabilities, which is great, but they are far from being able to pay off the total liabilities, which is negative. And if we take a look at the total liabilities, we can see it went from $35.2 billion up to $45.3, and these numbers have been growing every year. That is negative. I would like to see them start reducing the total liabilities and also reduce the rate, which is the total liabilities is growing. If we take a look at the outstanding share, we can see it went from 2.1 billion shares down to 1.9, and we can see that this number has decreased over the last 5 years, which is a plus. Basically, what's happening here, seeing that this number is decreasing, it means that the company is doing buybacks, meaning that your share of the company is growing. If this number were to increase, that means that the company is issuing shares, meaning that there are more and more available shares out there, meaning that your share of the companies is decreasing, meaning that you are being diluted as investor. And there's a lot of investors that either skip this part or doesn't know about it, because they be looking at a company's balance sheet and see that these companies have a lot of assets and the debt is not growing that much, which is positive, which is great. But on the other hand, we can see that the company is issuing more and more share, which is negative. But at the same time, that's a way for a company to bring in more capital without taking on more debt. So make sure to keep an eye on the outstanding share. But seeing that these numbers is decreasing, that is a plus. Now let's jump over to the cash flow, and what we're interested here is that the operating cash flow versus the capital expenditure, and we can see that the operating cash flow came in at $15.2 billion and the capital expenditure at $705 million, making a difference of $14.9 billion, which is great. Also, the fact that the total operating cash flow went from $9.3 up to $15, and these numbers have been improving. Fell off a bit in 2020, but overall trend positive. Capital expenditure came in at $707 million, down to $705, but we can see that they did improve these numbers, but have for the last 2 years seen lower numbers. But that is still positive, because I like the fact that they continue to invest in the business. Now let's jump over to the key figures, and what we can see here is that the earnings per share went from $3 per share up to $6 per share, and these numbers have been improving. Fell off a bit in 2020, but overall trend positive. Revenue per share went from $8.8 per share up to $12 per share, and these numbers have been improving every year. Fell off a bit in 2020, but overall trend positive. Equity per share went from $15.7 per share up to $19.4. Same thing, the numbers have been improving every year. That is a plus. Dividend per share went from 76 cents per share up to $1.45 per share, and these numbers have been improving every year. That is a plus. I like it because I like those recurrent income, but also the fact that the income is growing every year. That is a plus. That is amazing. Dividend share, we can see a bit of fluctuation, 23, 18, 18, 24, 22. I like this one because I like companies that pays out less than 60% of their capital, because I want some of the capital to remain in the business for investments, acquisition, and just overall strengthening the business for uncertainties. So this is a plus. Gross margin went from 86% down to 69.8%, and we can see that these numbers have been falling every year. That is negative. So guys, what is happening here is that the cost of goods sold is growing, and the company needs to find ways to become more and more efficient. And also, but still, these are high numbers, but we can see that the cost of goods sold is growing. So they need to work on their efficiency, and also we need to compare these numbers across the industry and see how is Visa doing compared to the competitors such as PayPal and MasterCard. Operating margin went from 63.7% up to 67.5%, and we can see we fell off in 2018, improved, fell off again. A bit of fluctuation, but overall trend is positive. I like that, so that is a plus. Profit margin went from 36.4% up to 51.7%, and these numbers have been improving. Fell off a bit in 2020, but overall trend positive. Return on equity, as I mentioned, tells you about a company's ability to create return on their equity, meaning their ability to create return on the capital you're about to invest in them. So seeing that they went from 20.4 up to 32.7, and these numbers have been improving. Fell off a bit in 2020, but overall trend positive. I like that. Return on asset went from 9.8% up to 14.8%, and these numbers have been improving. Fell off again in 2020, but overall trend is positive. Solidity tells you about a company's financial strength for the long term, and we can see here we went from 48 down to 45, and these numbers improved 1 year, but have since seen lower and lower numbers. This is negative. Balance sheet liquidity, same thing as solidity, but here it looks at the financial strength for the short term, and we can see it went from 7.3 down to 0.8, and they improved these numbers, perhaps, and seeing lower and lower numbers. This is negative. Debt ratio went from 1.07 up to 1.21, and they improved these numbers, but have since seen higher levels and improved in 2020, but overall trend is negative. So basically in 2021, having a debt ratio 1.2 means that they have 1.2 times more debt than equity, and seeing these numbers are increasing, that is negative. So guys, we have gone through the income statement, balance sheet, cash flow, the key figures. Now over to our key feature, which is the stock analyzer. And what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers, or have the software do the heavy lifting for you. If we take a look at the screen, we can see that the PE ratio above 20, which is negative. They pay out a dividend, which is positive, and the dividend payout share is less than 60%, positive. Dividends have increased over the past 5 years, positive. Number of outstanding shares have decreased, positive. Revenue increased over the past 5 years, positive. Profit margin above 15%, positive. Profit increased over the past 5 years, positive. Current assets are greater than current liabilities, positive. Solidity decreased over the past 5 years, negative. And balance sheet liquidity decreased over the past 5 years, negative. And debt equity ratio increased over the past 5 years, negative. And the total liabilities have grown over the past 5 years, negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. As I mentioned, if you want to dig through the numbers, you can dig through the numbers, or have the software do the heavy lifting for you. And you can have the software along with everything we've gone through, plus access to our discussion forum, where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comus.se and become a member today. Okay, guys? Thank you. But now let's take a look at the technical aspect of the stock. So here we have the chart. As you guys can tell, we have been moving within a positive trend channel for quite some time. We have seen the stock move above the trend channel and also back again towards within the trend channel, but has of lately moved back down within the channel, and now have more or less consolidating, indicating there are uncertainty here, and the investor doesn't know whether we'll see the stock price increase or whether we'll continue to move lower levels. But looking at the business, is strong, is stable, and the market is repositioning itself after the news of the Fed rates interest increase. So basically what I believe right now, and what I would do, is I wouldn't be buying right here right now, because what we are looking at is that we have a resistance level around here. If we go back a bit, we can see that these are key areas, because this support line, resistance level, have held for a couple of times, so indicating that these are strong key areas. So meaning that there are a good chance that what could happen is that the price start climbing, hit its ceiling, and then fall back down. And what I would do is, because of margin of safety, what I would do, I wouldn't be buying here, because if the price goes back down, I'll be losing a lot of money. So what I do instead, I'll be waiting as we move closer to these areas, because there's a lot of buyers waiting to participate and push the price even higher. So if we were down here, that would mean that we could see a price increase of at least 12%, 15 or 17%. That is okay. Now, I'm not not a day trader, so I'm more of holding the stock for a couple of years and just earn those capital gains and those dividends. So that's what I would do, is I would be very cautious, stay out of the trade and wait for the price and see if the price breaks below then for a potential buy. Other scenario it would be is we see here we have resistance here, and also we have resistance over here. So one scenario could be that the price breaks out of this the channel, comes back again and do a retest. I won't be buying here. I believe that there will be a lot of investors want to enter the trade here, but what I will do, I'll wait for a confirmation, wait for the price to increase, and if it breaks above this area here, then that would be a potential buy. But we have a different risk over here. We have a ceiling over here, so we might see something like that the price comes back up and hit the ceiling, comes back again. But what is good though is that we have a triangle formation forming around here. So what we could see is that the stock price hit the ceiling, comes back down, and a lot of buyers come back in and push the price even higher, and we start seeing something like this. So this is what I believe will happen. So therefore, I'll be staying out of the stock right now and wait for confirmations, basically waiting for the price to break above it before seeing what happens here for a potential buy. Otherwise, wait for the stock to hit the ceiling and be pushed back down for a better positioning and better safety of margin. So that's what I would do. So that's how I would trade a stock. How would you trade a stock? Please let me know in the comment section below. If you have any questions or have stocks you want me to do a video on, just let me know. And I truly hope you have enjoyed this episode. And please guys, give me a thumbs up, comment, subscribe. And until next time guys, take care. Bye bye.